There's a strange silence that follows every impulsive trade, a silence that feels heavier than the loss itself. You stare at the screen, not at the candlesticks anymore, but at your own reflection through the glass. The thought hits you. Was it really the signal that failed, or your perception of risk that never existed in the first place? Every trader wants certainty, yet the market was never designed to give it. What it gives is probability, a shadow of truth, never the full image. And how you engage that probability determines whether you are a gambler or a philosopher in disguise. You see, trading is often mistaken for prediction. People spend years chasing signals, optimizing entries, building the perfect indicator setup, but probability is not the science of certainty. It is the architecture of maybe. And inside that architecture lies the only real game worth mastering: risk. The world teaches you to avoid risk, to manage it, to survive it. But the philosopher, the intentional trader, learns to design around it, to shape it, to command it. Because risk is not an external enemy, it's an internal measure of belief. Let's pause for a moment. Think about the last time you placed a trade that felt right. The setup looked clean, the confluence made sense, the signal aligned with your rules. Yet something inside whispered uncertainty. That whisper was not fear. It was probability reminding you that perfection does not exist, only proportion does. That's where risk begins its true philosophy. In proportion, not prediction. The amateur treats probability as permission. The professional treats probability as context. And the philosopher treats probability as structure. Every time you take a trade, you are negotiating with chaos. The chart doesn't care about your conviction. It responds to your positioning, your control, and your willingness to absorb uncertainty without reacting emotionally. That's the essence of risk. Not how much you can make, but how much you can withstand while remaining functional. It's the reason why two traders can take the same setup, and one feels peace while the other feels panic. The difference isn't skill, it's philosophy. The first trader sees risk as a cost of participation. The second sees it as a threat to identity. And that single difference determines who survives long enough to understand probability as a living language, one that rewards control, not conviction. Pause again. Reflect on this. Every probability you face is an invitation to design structure. When you understand that, signals lose their emotional power. They become mechanical observations, not emotional triggers. Because you no longer ask, will it work? You now ask, if it doesn't, how does my structure absorb it? That shift from if to how is where philosophy begins. Probability, in its pure form, is not a percentage. It's a psychological state. It measures your relationship with uncertainty, not your mastery over it. The untrained trader confuses probability with prediction, the belief that high probability equals high certainty. But probability doesn't owe you anything. It simply exposes your readiness to accept variance without breaking structure. That's why some of the most intentional traders in the world rarely talk about being right. They talk about being consistent. They understand that consistency is not the repetition of accuracy. It's the repetition of control. Let's take a moment to dismantle the illusion. When you risk 2% per trade, you're not just defining exposure, you're defining identity. That 2% says, I am not my outcome. It tells the market that you have boundaries, that your behavior is anchored to a system that transcends emotion. You're no longer reacting to the candle, you're interpreting probability through the lens of structural philosophy. The moment you define risk intentionally, you stop being a participant and start being a designer. You're no longer guessing your way through chaos, you're structuring your relationship with it. That's the real difference between gamblers and model makers. A gambler plays to win. A model maker designs to last. And this is where many traders never evolve. They become slaves to signal chasing, an endless cycle of dopamine, hope, and despair, because they never learned that probability isn't a tool to find certainty. It's a mirror that reveals your discipline. Every trade you take reflects your tolerance for imperfection. That's why those who rely solely on signals are always chasing the next confirmation, because they cannot emotionally handle the truth that no signal can save them from structural absence. The truth is uncomfortable. Risk doesn't disappear through accuracy. It disappears through acceptance. And acceptance only comes through design. Here's something most traders never calculate: the emotional cost of unstructured probability. Every time you enter a trade without clearly defined risk parameters, you pay a hidden tax in mental energy. That tax compounds faster than drawdown because it corrodes your decision-making framework from the inside out. You become emotionally leveraged, overstretched by uncertainty, underprotected by structure. This is why I tell every member of the Trading Rebels community, stop worshiping the signal. Start mastering the risk philosophy, because the signal is just a moment. The risk is the movement. The way you engage probability determines whether that movement becomes growth or destruction. Imagine two scenarios. Trader A has a 70% win rate, but risks 10% per trade. Trader B has a 50% win rate, but risks 1% per trade. In 6 months, Trader A might make headlines until one losing streak wipes him out. Trader B might remain unnoticed, quietly compounding, emotionally stable, structurally anchored. Who's the better trader? Not the one who wins more, the one who remains. Longevity is not a reward for accuracy, it's the dividend of discipline. That's the heart of probability. It's not about being right more often, it's about surviving long enough for your structure to express itself. Every probability curve eventually rewards the trader who can sustain exposure without psychological collapse. That's the one metric most traders never measure: psychological drawdown. Because here's the secret. The market doesn't just test your balance, it tests your bandwidth. How many losses can you sustain before your philosophy cracks? How much variance can your mind absorb before emotion overrides logic? Those aren't market questions. They're identity questions. And that's why probability, in the eyes of an intentional trader, becomes personal philosophy. It's not about what the chart says. It's about what your internal structure allows you to interpret without distortion. The moment you see probability through that lens, trading becomes a mirror of consciousness. Each position size becomes a reflection of self-trust. Each risk level becomes an act of philosophical design. Now pause here. Look inward. How do you currently define risk? Is it a number or is it a narrative? Do you size based on structure or emotion? Because if your size is emotional, your philosophy is fragile, and fragility has no place in intentional design. If this resonates with you, if you're beginning to see risk as something deeper than numbers, welcome to the Trading Rebels doctrine. Here, we don't follow signals. We design systems that command probability through structure. Subscribe not to the channel, but to the mindset, because that's where transformation begins, not in what you trade, but in how you think. Let's return. Probability is not chaos. It's language. Every candle speaks, not in direction, but in rhythm. And structure is your interpreter. Without it, probability sounds like noise. With it, probability sounds like strategy. When you stop fighting variance and start designing for it, the market begins to feel predictable, not because it changes, but because you do. This is the paradox. When you surrender control of outcome, you gain control of process. And through process, you master probability. The key is to train your perception to see probability as a living entity, something that responds to your level of intentionality. The more structured your engagement, the more predictable your long-term results become. Not because the market gives you certainty, but because your system absorbs uncertainty efficiently. That's why the most powerful traders in history weren't signal masters. They were probability philosophers. They didn't prepare. They didn't chase. They calculated. And in doing so, they turned risk into rhythm. Let's end this first segment with a reflection. When you enter a trade, ask yourself one question. Am I positioning my capital or my ego? If it's ego, probability becomes personal. Every loss becomes an attack. If it's capital, probability becomes mechanical. Every loss becomes data. That distinction alone can transform a struggling trader into a structural one. Probability is not meant to make you rich. It's meant to make you real, to reveal where you still depend on illusion, to show you where your boundaries end and where structure must begin. In the end, risk isn't something you manage, it's something you understand. And understanding transforms risk from fear into framework. That's why, for the intentional trader, probability is never random. It's a design language, a conversation between your structure and uncertainty. And if you learn to listen long enough, It will tell you exactly how to survive, evolve, and command. Because at its core, trading was never about beating the market. It was always about understanding yourself through it. In the next segment, we move deeper into position size discipline, because probability without sizing is philosophy without form. We'll explore why the most dangerous thing in trading isn't losing, it's being overexposed to variance. Stay grounded, stay structured. You're not here to chase signals. You're here to build systems. Position size discipline. There's a quiet arrogance that lives in the mind of every new trader, the illusion that conviction is strength, that when you feel a setup deeply enough, it deserves more size, that the market somehow rewards confidence with precision. But the truth is more brutal, more elegant, and far more humbling. The market rewards proportionality, not passion. Position size is not about aggression, it's about calibration. It's the fine art of aligning conviction with uncertainty, not in ego, but in structure. Every position you take speaks your philosophy louder than your words ever could. Because position size isn't just a number, it's a statement of belief, not in the trade, but in your own process. This is where traders separate. The emotional trader sizes based on outcome expectation. This setup should work. The intentional trader sizes based on exposure tolerance. If this fails, my structure remains intact. That single distinction is the invisible line between chaos and command. Because in trading, you're not paid for prediction, you're paid for preservation. And preservation begins with size. When you reduce position size, most amateurs see weakness, but professionals see control. Because discipline isn't the absence of risk, it's the presence of proportion. Think about it. Every trade has 3 layers: entry, management, and exit. Most traders spend 90% of their time obsessing over entry, as if precision in timing could neutralize poor sizing. But the truth is, your position size determines your emotional temperature long before your entry ever executes. A small position allows for clarity. An oversized position breeds distortion. When you're over-leveraged, every tick becomes personal. Every pullback feels like betrayal. You stop analyzing and start hoping. You stop thinking in probabilities and start reacting to fear. And that's how structure collapses. Not because the market shifted, but because your internal balance did. Position size, in that sense, is your emotional thermostat. It regulates the heat of uncertainty. Too large, and your system overheats. Too small, and your growth stagnates. The art is in finding that equilibrium, where your mind remains calm enough to execute, yet invested enough to care. That balance point is not random. It's engineered through intentional design. The LET philosophy at its core is about turning chaos into calibrated structure, and position sizing is one of its most sacred expressions. It is where philosophy meets arithmetic. It's where theory becomes measurable behavior. Let's go deeper. When you define a fixed percentage per trade, say 1% or 2%, you're not merely managing capital. You're quantifying your emotional boundary. You're saying, I can lose this and remain whole. That statement is not just financial, it's psychological. It tells your nervous system that you are safe within uncertainty. This is why consistent sizing is the antidote to emotional volatility. When every position carries predictable risk, your mind stops negotiating with fear. It no longer asks, what if I lose? It simply executes within the framework. That's when mastery begins. When your execution no longer depends on emotion, but on mathematics and design. You see, position size discipline is not a trading technique. It's a cognitive reprogramming exercise. It rewires your nervous system to interpret uncertainty as normal, not threatening. This is where most traders fail. They think discipline is self-control. It isn't. Discipline is systemic conditioning. It's what happens when your rules become muscle memory and your structure becomes stronger than your impulses. Think about it this way. Every trade is a repetition. Every repetition, a signal to the nervous system. When you repeat consistent size and structure, you teach your mind that uncertainty can be survived. You build immunity. That's why unstructured traders are so easily broken by variance. Their exposure fluctuates with their emotion. When confidence is high, they overleverage. When fear returns, they undertrade. Their behavior mirrors chaos, and chaos rewards inconsistency with ruin. The professional understands the opposite. They maintain constant risk, constant process, constant presence. Because they know that the market rewards statistical persistence, not emotional reaction. Let's pause for reflection. When was the last time you reduced size after a loss? Was it strategy or fear? When was the last time you increased size after a win? Was it growth or greed? Those two questions reveal more about your trading maturity than your chart history ever could. Position sizing, when done intentionally, transforms you from reactive participant to deliberate architect. It ensures that no single trade defines your identity and no outcome threatens your continuity, because trading is not a sprint. It's a structural relay, a long-distance test of control. And the baton you pass from one trade to the next is emotional capital. Once emotional capital is exhausted, no amount of strategy can save you. You will start breaking rules you once swore by. You will start chasing losses you once rationalized. Because without sizing discipline, your system will always collapse under the weight of psychological inconsistency. That's why I call position sizing the governor of self. It governs greed, it governs fear, it governs illusion. And through that governance, it frees you to operate with clarity. If this message cuts deep, it's because you're awakening to the truth that mastery is not built on market knowledge. It's built on self-knowledge. Subscribe to Trading Rebels not for signals, but for structure. Every episode is a reprogramming tool, a way to rebuild your relationship with uncertainty. Because when you master your size, you master yourself. Let's continue. One of the greatest misconceptions about position sizing is that it limits potential. Many traders think, if I risk less, I'll grow slower. That's a half-truth. Small risk doesn't slow your growth. Inconsistency does. You don't grow by risking more. You grow by compounding intentionally. And compounding doesn't just apply to money. It applies to decision quality, emotional stability, and structural repetition. Every trade you take within disciplined risk parameters adds one more unit of stability to your system. And stability, over time, compounds faster than volatility ever could. Let's imagine two identical traders, both profitable. Trader A doubles down when confident. Trader B maintains 1% risk per trade regardless of conviction. In 1 year, both might make money. In 5 years, only one survives the variance storm. Because consistency doesn't just build profit, it builds longevity. This is the deeper layer of position size discipline. It's not a constraint, it's leverage. Not financial leverage, but psychological leverage. It allows you to scale clarity without scaling chaos. Every structured trader knows, when the mind is calm, the model breathes. When the mind is overexposed, the model suffocates. That's why discipline is not punishment, it's preservation. The untrained eye sees discipline as restriction. The trained mind sees it as freedom, the kind that allows you to trade without flinching, to lose without trauma, to win without euphoria. And here's the paradox. When your size is small enough to remain rational, your performance often becomes larger than you expect, because the market rewards consistency with probability alignment. It's ironic. The moment you stop chasing big wins start finding you. Because position size discipline keeps you alive long enough for probability to play its part. It turns randomness into rhythm. It transforms variance into pattern. It redefines loss as tuition. To wish every small, intentional position is a conversation with the market that says, I am here to learn, not to prove. And that mindset, that humility, attracts longevity. Now, think about the times you've broken your own rule, when the setup looked too good, when your conviction felt unshakable, when you told yourself, this one's different. It never is. It's always the same story. Emotion disguising itself as logic. Position size discipline is your defense against that disguise. It doesn't protect you from loss. It protects you from yourself. That's the essence of risk as philosophy. You don't eliminate uncertainty. You structure your participation within it. When you size intentionally, you no longer fear loss because every loss becomes predictable, quantified, contained. And when risk is contained, emotion has nowhere to hide. This is the structural secret most traders miss. Control doesn't come from knowing what happens next. It comes from knowing exactly how much you'll lose when it doesn't. That knowledge breeds peace, and peace breeds clarity. The real reason traders spiral emotionally isn't because they lose. It's because they lose unpredictably. Their losses vary in size, their behavior in tone, their reactions in chaos. That inconsistency erodes self-trust faster than drawdown ever could. Position size discipline restores that trust. It creates a rhythm that your nervous system learns to rely on. Over time, that rhythm becomes your trading heartbeat: steady, measured, calm. And when your trading heartbeat aligns with your structural rhythm, performance stops being forced. It starts flowing. This is why seasoned traders often describe trading as meditation, not because it's peaceful, but because it demands stillness within motion. Stillness comes from structure. Structure comes from size. When your position size is controlled, you can finally see probability clearly, not as threat, but as information. That's what separates emotional speculation from intentional design. The first reacts to the unknown, the second designs for it. In the end, discipline is the art of pre-deciding your behavior before chaos arrives. Position size is that pre-decision quantified, and that's why it matters more than the signal, because even the best signal will fail under emotional pressure. But the smallest size, when executed within structure, can sustain a lifetime of learning. The question is not, can you make money? The real question is, can you stay consistent enough to deserve it? That's the discipline test. In the next segment, we'll confront the hidden cost that most traders never measure: the emotional cost of risk. Because risk is not only financial, it's psychological. And if you don't structure your emotions with the same precision as your capital, your system will break long before your account does. Stay intentional. Stay designed. You're not here to follow emotions. You're here to engineer them. The emotional cost of risk. Every trader eventually discovers that money isn't the real price of risk. Emotion is. The balance you see on your screen is only the visible ledger. The invisible one is written in energy, patience, and mental capital. Every entry you take, every loss you endure, every uncertainty you navigate, all of it draws from a deeper account: your emotional equity. That's why the most devastating losses aren't financial. They're psychological. They happen long before the account blows. They happen the moment your confidence fractures, when your identity ties itself to the next outcome, when trading stops being mechanical and becomes personal. This is the emotional cost of risk, the silent tax the market charges you for misunderstanding yourself. It starts innocently. You take a loss, you tell yourself it's fine, you take another, you rationalize it. Then the third one hits, not just your balance, but your belief. You start to doubt your model, your timing, your process. And before long, you're not trading the market anymore. You're trading your anxiety. That's how unstructured risk consumes you, not through drawdown, but through erosion. The philosopher understands that risk isn't something you feel. It's something you structure. Emotion left unchecked turns risk into identity. But once structured, risk becomes just another operational function. You see, emotion isn't the enemy. Misplaced emotion is. Because emotion, when designed intentionally, becomes energy. The force that sustains engagement, not the one that destroys it. Let's go deeper. Every trader carries two emotional ledgers: the visible ledger, how much you gain or lose per trade, and the invisible ledger, how much confidence you gain or lose per experience. The unintentional trader obsesses over the visible. The intentional trader monitors the invisible. Because while capital replenishes, confidence does not, at least not easily. Once confidence is depleted, execution begins to tremble. Once execution trembles, probability becomes distorted. And once probability is distorted, the model collapses. That's the chain reaction of emotional cost. So let's ask the critical question: what is the true risk in trading? Is it the possibility of losing money or the probability of losing self-control? If you think it's the first, you're still early in your evolution. If you understand it's the second, you've begun the journey towards structural mastery. Because every emotional reaction has a cost, and that cost compounds faster than drawdown. Let's illustrate. Imagine two traders, both losing $500 in a trade. Trader A sees it as tuition, data that refines structure. Trader B sees it as punishment, evidence of incompetence. Same loss, two realities. One grows stronger, the other weaker. The difference isn't financial, it's emotional calibration. The market is neutral. It doesn't assign meaning. You do, and your meaning determines your endurance. The emotional cost of risk is measured not by how much you lose, but by how much energy you must expend to stay calm, rational, and functional after the loss. That energy drain, that psychological fatigue, is what destroys long-term performance. This is why traders with no risk framework always burn out, not because they lack skill, but because they keep paying emotional interest on unstructured exposure. Every oversized trade becomes an emotional loan. Every impulsive entry becomes psychological debt, and the market always collects. Pause here. Ask yourself, how much of your trading fatigue comes from financial loss, and how much from mental overexposure? Most traders confuse exhaustion with failure, but exhaustion is often just unregulated emotion. You can't think clearly when every tick feels like a verdict. You can't design structure when you're constantly trying to recover peace. That's the hidden trap. When emotion becomes your compass, every market fluctuation pulls you off course. And the irony is, emotional trading feels alive. The rush, the tension, the relief, they mimic purpose. But that's not purpose. That's chaos disguised as engagement. True purpose is calm, and calmness comes only through structure. That's why emotional neutrality isn't the absence of feeling. It's the mastery of interpretation. The intentional trader doesn't suppress emotion. They design around it. How? Through boundaries. Defined risk per trade, consistent size, clear invalidation points. These are not just mechanical parameters. They are emotional stabilizers. They transform risk from a personal event into a predictable metric. The more predictable your exposure, the less reactive your system. That's the real function of structure, not to eliminate uncertainty, but to make it emotionally survivable. Now, let's explore a deeper paradox. Emotional cost increases with the illusion of control. The more you believe you can make the market behave, the heavier your emotional toll when it doesn't. Control addiction is the root of trader burnout. It's subtle. You start believing your setup is special, your timing superior, your insight unique. That's when ego quietly replaces structure. You begin to over-identify with the next outcome. And the moment you do, emotion owns you. Because now every trade isn't just a probability, it's a personal test. That's when the emotional cost multiplies. The market doesn't punish ego through loss, it punishes it through variance. Variance stretches your belief system until it breaks. It shows you again and again that control is an illusion. And only when you surrender that illusion can you trade from true freedom. Freedom is not the ability to predict. It's the ability to remain stable when predictions fail. This is why position size, the structural anchor, directly affects emotional cost. When your size is small, your emotional expenditure is minimal. When your size is oversized, your nervous system enters fight or flight. You may still be looking at charts, but your physiology is already in survival mode. You cannot execute objectively from survival. That's why trading psychology cannot be treated separately from position sizing. They are one and the same. Structure and emotion are two sides of the same equation. If you're beginning to see that risk isn't about numbers, but about nervous system regulation, this is your cue to go deeper with Trading Rebels. Subscribe, not for motivation, but for structure. Because true confidence isn't emotional hype. It's engineered calmness. Let's continue. The emotional cost of risk isn't just about handling losses. It's about handling wins, too. Because wins carry their own distortion, the illusion of competence. After a few profitable trades, your brain begins to crave the same chemical reward. You confuse confidence with invincibility, and before long, your structure bends under emotional euphoria, just as it does under fear. That's the trap of unearned conviction. Both fear and greed are emotional debts. Fear borrows from your peace, greed borrows from your patience, and both charge compound interest. The only way to stop paying is through structure. When your risk is predefined, emotion loses leverage. When your process is consistent, variance loses control. When your size is fixed, confidence loses its arrogance. And suddenly, you begin to trade not to feel something, but to build something. That's the transition from reaction to creation. Emotionally reactive traders build memories. Intentionally structured traders build models. Every trade then becomes an act of authorship, not accident. This shift requires brutal self-awareness, because emotional trading often hides behind the illusion of discipline. You tell yourself, I'm following the rules, but deep down you know, your sizing fluctuates, your patience shortens, your reactions intensify. That's not structure. That's self-deception wrapped in ritual. True discipline is emotional objectivity, the ability to watch yourself think and still choose structure over impulse. It's when you can take a loss, feel the sting, and still execute the next trade exactly the same way. That's the highest form of mastery, emotional neutrality through procedural consistency. Now, here's the paradox that defines every elite trader. They care deeply, but act mechanically. They feel everything, but react to nothing. Because they understand that emotion is not the enemy, attachment is. The moment you attach your self-worth to a trade outcome, you begin a slow emotional bleed. Every fluctuation pulls at your identity until fatigue sets in. That fatigue is the emotional cost that kills your longevity. That's why the most consistent traders look boring to outsiders. Their emotions are structured, their reactions rehearsed, their piece designed. They've learned that trading is not about feeling powerful. It's about staying stable long enough for probability to express itself. And so they treat emotion like a variable in the system. Measured, controlled, integrated. That's emotional architecture, the construction of inner calm through external order. Ask yourself this: how much of your strategy is built to protect your account? And how much is built to protect your mind? Because until both are protected equally, you will always be one emotional spike away from chaos. The emotional cost of risk will always rise when your mental model lags behind your trading model. Your strategy may evolve, but if your psychology remains primitive, the imbalance will express itself through inconsistency. That's why evolution in trading is not technical, it's structural. To grow as a trader, you must rebuild your emotional architecture as carefully as your execution framework. That means creating rituals, not habits of reaction, but habits of regulation. Rituals that ground your nervous system before execution. Rituals that restore your focus after loss. Rituals that remind you, you are the designer, not the event. Because emotion cannot be suppressed, only structured. And that structure begins with awareness. The moment you can feel emotion without fusing with it, you begin to trade from consciousness, not compulsion. That's when the market stops defining you, and you start defining your response to it. Emotionally intelligent trading is not about staying calm, it's about staying connected to structure through every storm. And that, rebels, is the true edge. In the next segment, we move from psychology to architecture, into structural risk. We'll uncover how every model, no matter how refined, carries built-in vulnerabilities, and how intentional traders design around those vulnerabilities to achieve resilience. Because risk doesn't disappear through confidence, it disappears through design. Stay intentional, stay awake, and remember, emotion is data. Structure is interpretation. There's a quiet truth most traders never confront. Risk is not only a matter of how much you lose, it's also a question of what collapses when you lose. Structural risk is the kind of danger that doesn't just reduce equity, it erodes the very architecture that supports your decision-making. It dismantles your model, your consistency, and ultimately your identity as a trader. When we talk about structure, we're not talking about the lines on your chart. We're talking about the invisible framework that governs your interaction with uncertainty, the internal architecture that determines how your capital, psychology, and process hold under pressure. Signals live on the surface. Structure lives beneath. And while signals can fail 100 times without consequence, a single structural failure can wipe out years of work. Structural risk is therefore not an external phenomenon, it's internal decay. It begins when the trader starts treating the market as something to beat rather than something to understand. It spreads when habits replace principles, when the system becomes reactive, when execution loses hierarchy. A well-built structure anticipates disorder. A weak one assumes continuity. That's why the intentional trader doesn't merely build entries and exits. He builds containment. He builds control points, defined limits, measurable tolerances. Because in trading, survival is not about perfection. It's about how well your structure absorbs imperfection. Think of structure as the architecture of your behavior. Every routine you create, every parameter you define, every condition you enforce, they form the skeleton of your trading organism. Without that skeleton, you're just emotional tissue flailing in chaos. And when pressure hits, when drawdown, loss, Or volatility tests your equilibrium. It's not your strategy that breaks first, it's your structure. The unstructured trader confuses momentum with mastery. He adds size when he should scale back, shifts timeframes when he should hold discipline, and changes systems when he should reflect. Every reaction becomes a fracture, and soon what began as flexibility turns into fragmentation. The structure dissolves, and with it, the identity of the trader. The structured trader, however, builds differently. He understands that every rule he writes is not to limit freedom, but to preserve it. His parameters are not cages. They are boundaries of clarity. They exist so that when chaos enters, as it inevitably will, it doesn't destroy the foundation. Structural risk is what happens when the foundation is too thin to carry the weight of your exposure. The risk isn't in the trade, it's in the architecture that allowed that trade to exist without containment. That's why two traders can take the same signal at the same time with the same risk percentage and end up with completely different long-term outcomes. One has structural depth, the other has surface alignment. Let's take this deeper. Imagine a trader who risks 1% per trade but has no structured sequence of review, feedback, or psychological calibration. Every loss is absorbed emotionally, not structurally. Over time, the model becomes reactive. He begins adjusting rules mid-session, skipping entries, and second-guessing signals. The numerical risk is low, but the structural risk is high. Because what's being risked now is not just capital, it's the model's coherence. That's why the most dangerous losses are not always the largest. The most dangerous losses are the ones that shift your behavior permanently, the ones that make you stop trusting your framework, the ones that make you alter a system that was working because you emotionally overreacted to randomness. Structural risk is emotional contagion embedded in system design. You mitigate structural risk not by building more rules, but by building better relationships between rules. Systems fail not because their components are wrong, but because their components don't interact coherently. That's why a trader can have a perfect entry strategy, a solid risk rule, and a logical exit plan, and still fail. Because each piece is designed in isolation, not in interaction. Structure is a network of dependencies. Each part of your model must reinforce, not contradict, the others. The risk management must support your psychology. Your psychology must align with your time horizon. Your execution style must reflect your personality. If any of these components operate out of sync, the structure begins to vibrate under stress, and eventually, fracture. This is why intentionality matters. Intentional structure is not about memorizing what works. It's about designing a model that works for you, because structural risk is always personal. What breaks one trader may not break another. A system that feels stable for one may feel suffocating for someone else. The goal is not to copy structure. It's to author it. And authorship requires observation. You cannot design containment if you don't understand your own volatility. You must know how you respond to drawdown, to success, to stagnation. Structural risk management begins with self-awareness, because if you can't measure your internal movements, you can't stabilize them. Here's the paradox most traders never see. Structure doesn't limit creativity. It channels it. It gives creativity direction. Without structure, creativity becomes chaos. And chaos is expensive. But when creativity operates within structure, it produces innovation, refinement, evolution. That's the art of trading design, freedom built on boundaries. This is why structural risk must be approached as a philosophy, not a formula. It's not enough to say I'll risk 1%. You must ask, what system ensures that my 1% means the same thing every time? Because without consistency in structure, numbers lose meaning. Probability loses shape, and risk becomes random again. Your edge lives or dies by your structure. And every time you trade impulsively, every time you change a variable mid-run, every time you let emotion bypass protocol, you are not just risking money. You are eroding the architecture that supports long-term probability. If you've ever wondered why traders relapse into old habits even after years of progress, this is why. They rebuilt behavior, but never rebuilt structure. They changed how they thought, but not how their system contained those thoughts. And without containment, transformation doesn't last. That's why at Trading Rebels, we teach structure as covenant. It's not just a model. It's an agreement between your intellect and your discipline, between your freedom and your restraint. You build it, not because you trust the market, but because you trust yourself to respond within boundaries. Midway reminder: if this resonates with the way you see trading evolving beyond emotion and towards intentional design, subscribe to Intentional Trading on YouTube. Every episode builds a layer of structure, a deeper perspective into how you can command risk through design, not impulse. The market rewards precision. Let's make sure you're building it. Back to the framework. Structural risk often hides behind apparent control. For instance, over-optimization creates the illusion of precision, but hides fragility. The tighter the model is to past conditions, the less resilient it is to future ones. That's structural risk disguised as perfection. Similarly, diversification without structural coherence leads to internal contradiction. You may have multiple systems, multiple instruments, and multiple timeframes. But if they don't operate within a unified feedback share, your system will eventually self-conflict. You'll have one rule compensating for another's weakness until your entire model becomes reactive. The intentional trader doesn't diversify for comfort. He diversifies for correlation control. Every piece of his system exists to reduce total structural exposure. And that includes not just trades, but behaviors. You can't trade aggressively in one area and conservatively in another without recognizing the total system's emotional load. Structural risk compounds across domains. That's why you must map your trading like an engineer, not a gambler. Define not only where your system wins, but where it breaks. Build for failure before it arrives. Because if you can predict how your structure bends, you can prevent it from breaking. This is not pessimism. It's design intelligence. Buildings aren't built to never shake. They're built to shake without collapsing. Your trading model must do the same. That's the difference between fragile confidence and resilient conviction. So, what does this mean practically? It means auditing your structure under stress. Run through worst-case sequences. Ask, what happens if I lose 5 trades in a row? Does my capital plan still align with my psychological threshold? Can my time horizon absorb market stagnation without emotional cost? What happens if I can't trade for 2 weeks? Structural risk management is not reaction. It's rehearsal. You train your model to survive the inevitable, and in that rehearsal, something remarkable happens. You stop fearing uncertainty because your structure doesn't need the market to cooperate. It's built to outlast it. That's the difference between reactive traders and structural architects. The former trades to win, the latter designs to endure. Longevity, then, isn't a byproduct of luck. It's the logical outcome of sound structure. It's the natural result of eliminating weak connections, aligning internal systems, and reinforcing coherence. Because ultimately, every collapse in trading is a structural collapse first. Price doesn't destroy traders. Disorder does. When you understand that, you stop trying to control the market. You start controlling the conditions within which you interact with it. You stop being the victim of volatility, and you start becoming the architect of your probability. And that, Rebel, is the beginning of mastery. There comes a point in every trader's evolution where the goal shifts from profit to permanence. When you've been in the arena long enough, you realize that the real challenge isn't making money. It's keeping yourself operational long enough for the probabilities to pay you back. That's what longevity through control truly means. It's not about how far you can run when the market moves in your favor. It's about how gracefully you can survive when it doesn't. It's the quiet discipline of remaining coherent, consistent, and calm while others are consumed by volatility. Most traders approach longevity as a numbers game. They think if they just follow strict risk percentages, avoid revenge trading, and maintain good entries, they'll endure. But that's surface-level longevity. True longevity is structural, psychological, and philosophical. It comes from a relationship with control. Not control over the market, but control over self. Control, in this sense, is not the suppression of emotion, it's the orchestration of it. It's the ability to regulate exposure, energy, and expectation. It's the deliberate synchronization of your behavior with the probabilities you've designed into your structure. Because at its core, control is not rigidity. It's rhythm. When you design a trading structure rooted in intentional control, you create feedback systems that allow you to detect drift early. You notice when your execution speed begins to deviate. You catch the subtle hesitation before it turns into avoidance. You identify emotional noise before it becomes a behavioral loop. That's not luck. That's architecture. Every sustainable trader understands this. Survival isn't about avoiding chaos, it's about integrating it into your design. Because no matter how advanced your model, uncertainty will always exist. The difference between collapse and continuation lies in your capacity to remain functional within that uncertainty. Longevity, therefore, is not passive endurance, it's active equilibrium. You stay alive in this game by adjusting without losing identity, by adapting your structure to shifting environments while preserving your philosophical core. This is where control becomes a spiritual practice. Because when you no longer trade for validation, when your sense of self is not tied to outcome, you enter a state of structural peace. You no longer chase the market. You align with it. You understand that the edge is not an external variable. It's a reflection of how deeply you understand your own system. That's the difference between trading as performance and trading as philosophy. Performance ends when conditions change. Philosophy endures through every condition. Longevity is the byproduct of design married to self-mastery, and it begins with the smallest daily choices. How you size, how you stop, how you step back. Every decision either reinforces or erodes your control. Every micro interaction with the market either strengthens your structure or weakens it. Over months, those micro decisions form macro outcomes. If you're reactive, you'll always oscillate between overconfidence and fear. You'll risk too much when you win and too little when you lose. But if your control is intentional, you operate with consistency independent of outcome. You size because the structure demands it, not because your emotions suggest it. You take loss without identity friction. You execute without needing affirmation. That's what keeps a trader operational for decades, not months. There's an old truth in probability theory. Given enough trials, the outcome always reflects the system's bias. But in trading, most never reach enough trials. They burn out before the bias can express itself. They self-destruct in volatility because their internal systems weren't built for longevity. They had tactics, but no philosophy. That's why risk as philosophy is so critical. Philosophy is what keeps you stable when systems fail. It's what allows you to rebuild when drawdown happens. It's what keeps your structure intact when nothing else works. Because philosophy gives meaning to repetition, it makes consistency an identity, not a chore. And that's the secret of longevity. When consistency becomes who you are, not what you do, endurance stops being effort. It becomes nature. Now let's bring this closer. Longevity through control is composed of 3 layers. 1, behavioral consistency, the predictable execution of structure. This is your baseline survival. You do what your plan says, even when your feelings disagree. You control variance by controlling yourself. 2, psychological regulation, the internal calibration of energy and focus. This is what allows you to stay sharp without burning out. You learn to recover faster, to reset quicker, to detach efficiently. 3, philosophical alignment, the deepest layer. This is where trading becomes expression, not reaction. You stop fighting the market because you understand its nature mirrors your own. You trade not to conquer chaos, but to discover order within it. When these 3 layers converge, you don't just survive trading, you inhabit it. You become part of the market's rhythm. And that rhythm keeps you alive far beyond those who depend on momentum or luck. You've seen it. Traders who appear invincible for a year, maybe 2. They double accounts, flaunt returns, build followers, then one bad cycle arrives and everything unravels. The issue wasn't their signal, it was their structure. They never built containment. They never built control. They were fast, not stable. Speed can make you rich. Only control can make you last. Because the market doesn't reward the bold, it rewards the balanced. Those who know when to press and when to preserve. Those who understand that control is not hesitation, it's awareness in motion. At Trading Rebels, this is our core philosophy. Mastery begins where control becomes conscious. You are not here to predict markets. You are here to command probability through structure. And structure is sustained through control. So if you're listening and this resonates, if you felt the chaos of inconsistency, the emotional fatigue of reactive trading, or the exhaustion of chasing setups without stability, then it's time to make a shift. Subscribe to Intentional Trading. Rebuild from within. Every episode is designed to retrain your perception of risk, to convert emotion into structure, and to turn control into longevity. Now let's go deeper. Control isn't about winning more. It's about losing well. Because in losing well, you preserve the ability to continue. Most traders destroy longevity in their response to loss, not in the loss itself. They increase risk, change system, or trade to recover ego. Each of those actions compounds structural risk. But the controlled trader views loss differently. To him, loss is data, feedback for structural refinement. He doesn't attach identity to it. He studies its pattern, its frequency, its psychological impact. Because he knows longevity isn't a battle against loss. It's an alliance with it. Loss, in that sense, is structural information. Every time you take a loss, your system is showing you where it flexes. Control is what allows you to see that flex as insight rather than insult. That's how you build emotional immunity. Not by pretending you're fearless, but by structuring your process so deeply that fear loses its function. The more control you have over your internal architecture, the less the market can disturb your equilibrium. And that, Rebel, is when trading stops being survival and becomes authorship. You stop trying to control outcome. You begin shaping experience. Every trade becomes a line of code in your system's evolution. Every decision adds to your internal design. You no longer trade for profit, you trade for refinement. Profit becomes the inevitable byproduct of structural clarity. Longevity through control is therefore not about staying safe, it's about staying available. Because you cannot capitalize on opportunity if you're psychologically unavailable to perceive it. The market rewards those who can remain present across time, not those who peak in emotion. You stay available by maintaining balance between exertion and recovery, between risk and restraint, between output and observation. When that rhythm is broken, control deteriorates, and so does longevity. The intentional trader structures rest as deliberately as execution. He understands that fatigue creates cognitive distortion, and distortion breeds structural error. That's why control extends beyond the chart. It governs your entire ecosystem. Your energy, your habits, your environment, they are all part of your risk framework. Longevity is not built in trades. It's built in routines, in the spaces between execution, in the stillness after action, because those moments define your clarity. And clarity is the ultimate form of control. So, Rebel, remember this. The market doesn't destroy the disciplined. It simply tests the depth of their design. Longevity belongs to those who build deeper than they react. Those who understand that the real edge isn't in the entry, it's in the architecture. When you learn to live in that structure, when control becomes second nature, you don't just trade longer, you trade truer. Every action aligns with intention. Every loss refines your model. Every outcome reinforces your philosophy. And when you reach that point, you've crossed the threshold from being a trader to becoming an architect of probability. That's the essence of risk as philosophy. Understanding that the greatest form of risk management is the creation of structure that outlasts you. Because in the end, markets will evolve, systems will change, technology will transform, but structure will always remain the language of longevity. And your control, the ability to remain coherent in motion, will determine whether you merely participated in the market or mastered it. You've just experienced the Trading Rebels deep dive on risk as philosophy, why position size matters more than signals. If this shifted your perception, if you're ready to design structure instead of chasing setups, then join the intentional trading movement. Subscribe, engage, rebuild. Because the next evolution of trading isn't about prediction. It's about precision through design. Stay structured, stay intentional.